You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. We're doing something a little different today. We're in episode 2 of about a 100-part series designed to walk through macro fundamentals from the ground up. So if you're new to the world of economics, trading, or policy, this series is definitely built for you. This deep dive is called Everything is Connected. You know, so often when you just look at one chart, say euro-dollar, you get this kind of blind spot, right? Treating that pair like it exists all on its own.
Yeah, exactly. And that separation, that silo effect, it's the hidden cost that really eats away at your conviction. Ignoring these global connections, this sort of domino effect of global finance, that's precisely what holds people back from better timing, stronger certainty their decisions.
So today we're going to unpack 3 specific case studies. We'll show you exactly how currencies can respond to commodities, how bonds influence currency moves.
And really how this intermarket awareness gives you a genuine edge, a clear one.
Let's unpack this. Okay, so let's start where most trading journeys seem to kick off. The foreign exchange market, FX, it's heavily marketed, it's accessible.
Super accessible, and often the first stop for new traders, yeah.
But that ease, it kind of creates this illusion, doesn't it? That it's simple.
It really does.
Yeah.
Because you can technically trade a pair, like, say, cable or euro-dollar, just by itself. People start treating it like it's in a vacuum.
Right, a total silo.
And that focus, that narrow view, it creates this huge blind spot. You end up just staring at the price going up and down on one single chart.
And that's the real danger. We've got to internalize this core truth right away. Nothing in these markets moves alone. It just doesn't.
Nope. You can't really look at oil without considering the dollar, can you?
And you can't look at the dollar without at least glancing at what the bond market's doing.
It's one ecosystem. That's the key. Every asset class, stocks, bonds, currencies, commodities, they're just different reflections of the same underlying capital flows and, risk sentiment.
So these connections, these intermarket relationships, they're not always perfectly neat or permanent, I guess.
No, not always clean, and they definitely evolve over time.
Yeah.
But ignoring them, that means your technical setup, no matter how good it looks, is only ever half the picture.
So you could have this perfect chart pattern.
Yeah, the textbook setup. But these outside forces, whether it's commodities or yield spreads or just overall market mood, they are constantly either giving your trade a helping hand or quietly, subtly undermining it from behind the scenes.
Okay, let's make this concrete. Example number 1. The link between currencies and commodities. Let's use the Australian dollar, the Aussie dollar, and iron ore.
Good one.
So imagine you, the listener, see a classic buy signal on Aussie dollar. Maybe it's pulled back perfectly to a key support level on the chart. Looks great.
Okay, so before you hit that buy button, the immediate next step, the non-negotiable step for the Aussie, is checking iron ore prices.
All right, hold on. Why? For someone new to this, why should the price of, this lump of metal dictate where a major currency like the Australian dollar is headed?
Yeah, fair question. It basically boils down to the country's economic guts, specifically something called the terms of trade.
Terms of trade. Okay, break that down.
It's simpler than it sounds. It just measures the price Australia gets for its exports compared to the price it pays for its imports. And for Australia, iron ore isn't just an export, it is the export by a huge margin.
Ah, okay. So when iron ore prices go up, Australia is effectively getting paid more for its main product on the world stage.
Exactly. More income flowing into the country. That strengthens the economy fundamentally, and it increases global demand for Aussie dollars because people need them to buy that iron ore or, invest in the success. It's like their primary financial engine.
Got it. So flicking that around, if iron ore prices have been tanking for weeks,
then that's a huge red flag. It signals that Australia's main revenue stream is drying up, shrinking. And that puts intense downward pressure on the currency from a fundamental standpoint.
So my beautiful technical setup on the Aussie dollar chart
might be walking straight into a fundamental hurricane, a gale force headwind.
That clicks. But, quick question, does this correlation ever just break? Can the chart pattern sometimes win out even if the commodity signal is flashing red?
Well, occasionally. If you get something massive and unexpected, like, say, the Reserve Bank of Australia shocks everyone with a huge rate hike, maybe 75 basis points.
Right, like a policy bomb.
Yeah. That kind of monetary policy move can briefly decouple the currency from the commodity. But generally speaking, think of the commodity price like the main river current.
Okay.
If you try to buy the Aussie while iron ore is collapsing, you're essentially paddling upstream. You're fighting the country's primary financial driver. It's a low probability bet most of the time.
So the wisdom here isn't just take the trade because the chart looks good. It's maybe, wait for that commodity backdrop, the iron ore price, to at least stabilize, or better yet, turn around, make sure the current's with you.
Precisely. You want the wind at your back, not in your face.
Okay, relationship number 2. This involves fixed income, the bond market acting as this crucial barometer for currencies. Let's stick with a major pair, euro-dollar.
Okay.
So you're looking at the euro-dollar chart. Maybe it's pulling back towards a clear resistance level. Looks like a potential spot to sell, to short the pair.
Standard technical setup.
Yeah.
So what's the intermarket check here?
The next step is checking the yield spread. Specifically, the difference between the yield on the 10-year U.S. Treasury note and the 10-year German Bund.
Right. And for anyone unfamiliar, the Bund is just the German government's main 10-year bond. It's their equivalent of the U.S. Treasury.
So we're comparing the interest rate the U.S. government pays versus what the German government pays for borrowing over 10 years.
Correct. The yield spread is simply the difference between those two rates.
But why is this specific spread, U.S. versus German 10-year yield, such a big deal for euro-dollar? Why is it a key barometer?
It's fundamentally about where big money wants to park itself. It's about capital attraction and relative interest rates.
Okay.
Think of it maybe like comparing two savings accounts, one in U.S. dollars, one in euros. If the U.S. 10-year Treasury is yielding, let's say, 4.5%, and the German 10-year Bund is only yielding 2.5%.
The spread is 2%.
Right.
Okay.
That 2% difference is significant. It means big global investors get a much better return, adjusted for risk, holding dollars in those treasuries than holding euros in bunds.
And capital chases higher yields, doesn't it? It flows to where it is paid more.
That's the engine. So when that spread widens, meaning the U.S. yield advantage gets bigger, global investors need more dollars to buy those higher-yielding treasuries. That demand pushes the dollar stronger and, consequently, the euro weaker.
And if the spread narrows?
Then the relative appeal starts to balance out. Maybe the euro finds some support, or at least the downward pressure eases off.
Okay, this context is huge. So back to my potential short trade on euro-dollar. The chart looks great, maybe hitting resistance.
Looks perfect, technically.
But then I check that yield spread, and I see it's still aggressively widening, still moving strongly in the dollar's favor.
Then you know the underlying macro pressure, that fundamental capital flow, hasn't actually stopped yet. The tide is still going out for the euro.
So I might be technically right on the chart pattern, but just too early from a flow perspective.
That's exactly the intermarket edge. You're seeing the why behind the price move, the underlying motivation for capital. You might still decide, okay, I'll take a small position, but now you know you're fighting the dominant flow.
Which means maybe tighter stops, smaller position size.
Exactly. You manage the risk differently because you have that crucial context. You're absolutely no longer just walking in blind, relying purely on a candlestick shape or a line on a chart.
That awareness, yeah, that builds real conviction, or tells you when to wait. Okay, let's hit our third key relationship. Currencies and equities, thinking about it as trading global confidence. We'll use Kiwi Yen, NZDJPY.
Good example. Classic risk proxy.
So you spot what looks like a compelling setup on the Kiwi Yen chart. Maybe it's bounced nicely off its 20-day moving average, looks ready to climb.
Standard procedure, so the intermarket check.
Glancing at the global equity market, the S&P 500 is a good proxy, for instance. Why? Because this pair, Kiwi Yen, is really sensitive to global risk appetite.
Yeah, let's unpack risk appetite quickly. What does that mean in this context?
It's basically the market's collective mood, isn't it? Its willingness to take on risk.
Pretty much. When investors feel confident, maybe economic news is good, stocks are generally rising, things feel stable, they tend to buy higher-yielding currencies linked to global growth, like the New Zealand dollar or the Kiwi. That's risk on.
They're reaching for yield, feeling optimistic.
Correct. And they often fund those trades by selling or borrowing in a low-yielding currency. And the Japanese yen.
It's a classic safe haven, low yielder.
Traditionally, yes. Often because Japan has had very low interest rates. So it becomes a preferred funding currency. You borrow yen cheaply to invest in something riskier, like the Kiwi, hoping to profit from the difference.
Okay, so that's risk on. What about risk off?
Risk off is the opposite. When fear spikes, maybe there's bad geopolitical news, a major bank looks shaky. Or, like you said, stocks tumble, investors ditch risky assets. They rush for safety.
And safety in FX often means buying back the yen they borrowed or just parking cash there.
Exactly. They sell the Kiwi, buy the yen. That pushes Kiwi yen down hard.
So back to the scenario. I'm looking to buy Kiwi yen based on that moving average bounce. Fundamentally, I'm making a bet.
You're betting on global confidence staying high or increasing.
Right. But what if, at that exact moment, the S&P 500 suddenly drops, say, 3% intraday because, I don't know, some huge tech company misses earnings badly and guides lower?
Then the entire premise of your Kiwi yen trade, that assumption of stable or rising confidence, just got blown out of the water, instantly invalidated.
Doesn't matter how good the chart looked.
Not really. That collapsing global risk sentiment can easily drag Kiwi yen down with it, pulling it right through that moving average support. When you trade Kiwi yen, you're not really trading the New Zealand economy versus the Japanese economy in isolation.
You're trading global confidence.
That's the core driver you absolutely must keep an eye on.
Okay, let's tie these three examples together now. We've got commodities as a physical driver, bond yields as an expectational or capital flow driver, and equities reflecting overall confidence or risk sentiment.
3 different angles, same principle. Connection.
Now, getting this intermarket edge sounds like it could be a ton of work. Like you need to become an expert analyst in iron ore, German bonds, and U.S. tech stocks overnight.
Yeah, it sounds intimidating, but it's really not about that. It's much simpler. It's about building a habit.
Just asking one more question, checking one more chart.
Exactly that. Just add one relevant intermarket check to your routine before you place a trade. The really powerful insight here is that the most important signals for your trade often don't even show up on the chart of the asset you're actually trading.
They show up one step removed.
Precisely. In the price trend of iron ore if you're trading the Aussie. In that widening yield gap between U.S. and German bonds if you're looking at euro-dollar. Or maybe in the S&P 500 futures tanking overnight if you're considering Kiwi yen.
So by adopting this sort of wider view,
You shift from just reacting to patterns on one screen to proactively analyzing the bigger picture. You start seeing the why.
and the benefits seem pretty clear, spotting higher probability trades because you know the bigger forces are aligned.
Having that fundamental wind at your back, like we said. More conviction.
Avoiding those frustrating false entries where the chart looked perfect but the context was wrong.
Huge. Saves capital and frustration.
And maybe the biggest one, improving your timing. Knowing when to wait for those outside drivers, the yield spread, the commodity, to actually confirm the pressure is shifting in your favor.
Absolutely critical. Because honestly, when we look back at trades that didn't work out, the ones where we were too early, too late, or just plain wrong,
Yeah.
the fault often isn't really in the specific chart pattern we traded. It usually comes down to whether or not we understood the interconnected forces playing out behind that chart, that broader awareness. That's the ultimate edge you can build.
Appreciate you tuning in for this deep dive into intermarket connection. Some really crucial ideas there.
Yeah, we covered how looking beyond just one chart can really build conviction, especially when things feel volatile out there.
Definitely. Join us again on the Financial Source podcast as we continue to build your foundation in macro fundamentals.